The housing market is cracking, crumbling, changing. Some would say it's going into a deep freeze. Others want to talk about it, falling off a cliff. I believe that the housing market is going to suffer the largest crash in transactions. I believe you have educated my entire audience on how builders react, right? Sell off the current inventory and slow down. But what are you seeing, right? National Association of Realtors put out a report last week. Realtor.com has put out a report. What are you seeing going on in the housing market?
Yeah, so it's interesting, in terms of what is happening. Obviously, we're seeing a cooling off. We're seeing inventory levels rise. The report just came out that said that, new listings were down 3% from a year ago. They're all relative numbers, right? But what's really interesting to me is there's still a lot of markets that are still red hot, getting multiple offers, maybe not like 30, like they used to, and lines out the door, but they're still selling in days, at or above asking price with multiple offers. Some properties in some areas, my area specifically, inventory levels are still way low in certain areas. And, so we're, the big thing is interest rates haven't gone high enough yet to fully correct the market. So and then the whole, thing about less sellers now, because in addition to inventory levels rising or new listings rising, there's less people willing to sell right now. So it's kind of conflicting information. So the question is, well, what do you do with that? Inventory, obviously, the number of listings is going up, but the number of sellers is going down. So what's happening? So what's happening is people are looking at it and going, well, shoot, interest rates are up. There's nothing out there. So why should I sell? What's the point? So we're kind of in this catch-22 where the housing market desperately needs to correct, but there's nothing out there. Nobody wants to sell because there's nothing to buy. So, how does this all work itself out?
Well, this is where my brain went 3 months ago. And that's why I called the greatest housing crash. I didn't talk about price because we actually have, for the first time, and I've been studying the housing market in detail for 30 years, and I have gone back to 1970. So I've looked at it for 52 years. And this is the first time since early 81, 82, that's 1981 and 1982, where we have now seeing demand destruction and supply destruction. It is a very interesting soup because everybody wants the price to crash, but I'm sorry, if there's no transactions, there's no price discovery. And it just doesn't. That's why we didn't have again, folks, we've had an environment where rates have doubled in a very short time and values didn't go down. And people are like, oh my God, how can that happen? Even Patrick Bet-David just did a valuetainment, housing crash is coming because rates doubled. Well, buddy, we have historical evidence that's not the case. Transactions are going to crash because you just lost 18 million buyers because they can't afford it 6%, they can afford it 3%. And you have supply destruction because you have all these first-time homeowners and move-up buyers stuck because who's going to ask to triple their mortgage payments? I'm just going to stay put and buy bunk beds. I'm not going anywhere. So it's a really weird time.
Yeah. And then now the whole affordability index has flipped. So it's cheaper to rent in a lot of areas than it is to own. So that's flipped back the other way with rates where they are. The only thing that really drove the housing market like it did, obviously people pulled their houses off the market during the pandemic and all that, or didn't sell because of different reasons, but interest rates. It's always interest rates. It always comes back to interest rates. So in one point, he's sort of correct, but they're not high enough yet. Rates have to get into the upper 6s, into the 7s for, if you want a market crash, forget transactions, but values, and you want the market to crash, you got to get up into the 7s.
I think there's two things that have to happen. I didn't mean to cut you off, but I think this is important. First off, I want to be clear when I agree with you that 7 is the number. But for me, because I've already seen consumer behavior change, adjust the arms, right? The 5-1, the 7-1 arms have to get to 7. Because if the 30-year fixed gets to 7, but arms are still 5, people are just going to switch to the 5 and they're going to play the game. The Fed will cut and I'll just refi later. The arm has to get there, I think. Do you think that's true?
Oh, yeah. That's the other thing I was going to say is because you can still get in the 4s with an arm right now.
Exactly.
So that's the other problem with what's keeping rates, or the market so, stuck and, out of whack is for that reason, so, there's a couple of things that need to happen for that crash to come to fruition. And the other thing he's looking at is units in production coming online from the builders and things like that. And see, the builders are smart. We all know what happened in 08, 09. And most of the building companies out there were around back then that are big building companies. So we're going to, we cut back, right? We just don't, we don't start.
They're
you know,
slowing down. You told us this 33 months ago. I asked you, we did a whole episode on what are the builders are going to do, and you nailed it. Michael, they're going to take their finished product that's done. They're going to discount it. They're going to blow it out. They're going to get their capital back. And then, Michael, they're going to slow their ass down. That's what builders are laying people off because that's how slow they're going to go.
Yeah. Oh yeah. Yeah. So, you know, that's where it starts. That's where you see it first is in home building and real estate. So the other thing we can talk about in a second is, you know, like people might think, you know, crash in real estate transactions. So what? What does that mean? But we'll talk about that in a second because that is important.
It is.
You know, a lot of people might think that's not important. You know, it's values and it's no, transactions are key.
I agree.
So, you know, but yeah, it shows up in the builders first. They're going to discount. They're going to blow it out. They're not going to start. And, you know, they did have another exit, you know, with the, you know, build to rent investors out there, but they're pulling back because their cost of capital now is at a level where it's not making a lot of sense. However, you know, I just read a story or heard an article the other day. I can't remember where I heard it, but Blackstone is raising, you know, $5 billion for, you know, the house for real estate to take advantage of distressed real estate.
I actually read that article. It was 50 billion.
50 billion. I'm sorry. Yeah. 50 billion for distressed real estate. Now, that doesn't mean houses, you know, that there's all kinds of real estate that they're really after, and they're probably going to buy more multifamily than anything else.
I actually, you know what? I actually think they're going to buy office. I don't know if you've heard, but San Francisco is about to have 42% vacancy. Their DCR loans are going to blow up. My guess is Blackstone owns a couple of San Francisco office towers here very soon.
Yeah. Yeah. So, you know, yeah, it's whatever, but it's not going to be single family homes.
No, it's not going to be.
They're going to go buy all these houses.
No,
that's not what they do.
No,
they don't buy houses. They buy the toxic, they buy the bad mortgages.
They want discounts. They want, yeah, they're not paying. Blackstone does not play retail, folks. Blackstone is the company I brought to you. I think it was Sunday. They just made the largest profit on the single asset sale ever. They bought the Cosmopolitan Hotel in Las Vegas for about 1.3. They sold it for 5.4. In about an 8-year period, they made $4 billion. Blackstone don't play, but they buy stuff on sale. And I think it's going to be office is what they'll be buying. My wild ass guess. Yeah, we'll see. It'll be interesting to see what they end up doing. And, you know, they're global as well. So distressed real estate isn't just in this country. China's going through a big, huge correction, but, you know, nobody wants to invest over there right now because, you know, Xi Jinping or whatever his name is, how you pronounce it, he's just going totally the opposite. You know, China wanted to be a world leader, a global superpower, and some people were calling for the, you know, yuan to become the world's reserve currency. I mean, it's just not possible when you have that type of environment, anti-business, you know, anti-globalization. Interesting how they shoot themselves in the foot. They shot themselves in the foot, reloaded the gun, and then shot the other foot. I mean, they've done some crazy things. So it's going nuts. But anyways, let's talk about that crash in transactions, because a lot of people might hear that, say, "Oh, I'm calling for a crash in transactions." Be like, "So what? What does that mean?" Yeah, I get. Believe me, I get that a lot. People are like, you know, that's not helpful. I'm like, you guys don't understand. This is going to lead to a significant recession. This is a bad thing. So just like builders cutting back, you know, that's jobs, that's income. So, you know, for one house being built, you're talking about thousands of reverberations of, you know, money going into the economy. And that's how the money works, right? You know, money comes from me to you to whoever, and it's just this huge cycle. And, you know, the way the economy works is in business cycles, right? You have, you know, you have growth, you have peak, you have recession, depression, and the cycle starts over again. And, you know, it's the economic business cycle that the world operates in, and it's global. But in this country, there's a lot of residual, you know, growth added to the GDP that goes through the economy based on housing at all levels. So construction, so that contracts first, and transactions, that contracts. So that's people that are making money off that transaction, realtor commissions that they put in the economy, all the other different businesses that are involved in that transaction. So just like when a builder cuts back, if transactions cut back, and you're seeing it first, mortgage market, right? So the mortgage lenders, they're the first ones to go. Then realtors, you know, they start laying off and cutting back, and everything from advertising, marketing, staff, just everything. So it's a huge factor in the economy. And then, of course, that always front loads, you know, the actual housing corrections that come down the line. So transactions are a pretty important metric. And of course, you know, those things can fall off a cliff and drop by, you know, huge numbers. So in terms of a housing market crash, that doesn't really represent anything there, but from an economic standpoint, it's a big deal. I think it's a gigantic deal. And that's what I've been trying to communicate on my channel for 3 or 4 months is people keep pushing housing crash and prices. I'm like, sorry, maybe in a couple of local markets, but the median housing price year on year is not crashing in 2022, and people don't like that. However, I've been very stout that we could potentially have a 30% crash in real estate transactions. And I don't know if you know this, but we're already down 1 million. We did 6.3 million last year. Last month, we were on a run rate to do 5.3. That's 1 million transactions.
Yeah.
That's just existing home sales.
And it's got to go a lot lower than that for the market to correct and really get back to a healthy level. Because again, we're in that catch 22. And, the only thing that can kind of help catch it up is when the builders finish, because there are some inventory in the pipeline. There's several million houses.
It's a couple of months. There's a couple of months of discount. Again, people are looking at builders going, oh my God, they're cutting costs. The world is over. I'm like, no, go get a deal, because they're going to blow it out. And then they're going to slow down to a snail's pace.
Yeah. And it's a little early right now. Summer's always a little bit skewed because, especially now, because people have been locked up the last 2 years. So this summer, especially, people are, they're out, they're taking their vacation, they're going, they're traveling. So things always slow down a little bit in the summer. So, things will be a little bit skewed right now, but come, the end of the year, when they need to clean the books up, that's when they're really going to be discounting any kind of inventory. They don't want to go into the end of the year with inventory. They want to get that stuff off the books. So just like car dealers or anybody else, end of the year is a good time for bargains in a lot of different areas. Just because they don't want to go into the new year with all that inventory. And same thing with banks that have their money, they want to put it out the door at the end of the quarters, end of the year, good time to borrow money. So, it'll be interesting to see how this all plays out and where it goes, but we need much higher rates. And unfortunately, we'll talk about that in the next episode. Bond rates aren't cooperating.
Oh, no, they're not. No, they're not. That's crazy.
Yeah. And it's because of recession fears, right? So, but we'll get into that next episode. But it's all important. It's all connected. And it's an interesting, conundrum we're in right now with the housing market, because it's nothing like it was. So in 2008 and 2009, it wasn't just the bad assets, toxic mortgages, bad loans, predatory loans. It wasn't just that. It was the recession on top of it that was created from the housing market. Like you're talking about transactions and builders cutting back. I mean, the recession, real recession, where jobs were lost, companies were going out of business and you couldn't borrow money and things like that, created bankruptcies and foreclosures. And we're not seeing that right now. They're at really record levels. When you look at this, chart, you can see that kind of just dropping off a cliff. Yeah. So, arguably the economy obviously is much healthier than it was in 08, 09. And, you're just not going to see a housing crash like we had back then because of that. That's not going to be the catalyst.
No, when I think about because again, I'm very certain median home price for the United States will not have a negative number in 2022. If we're going to talk about 2023, I'm willing to entertain it. I think there are two things. One, we've already hit rates on ARMs. We're talking 5.1, 7.1s have to be in the 6s. 7s would be better if you want to crash. But there is another one, and you just hit it. It's the job market. The job market has to go from 3.6% unemployment to at least 7.5%. You need that cascading negativity, right? You need not only high rates, but you also need a weakening job market. You also need to have a recession because of housing, which I think we already started. So you get all that toxic soup building and it's a year long, you might have some price deterioration at a national level. You're certainly having it in cities, but that could be a national problem with all of that lined up.
Yeah. And not that we want that or want to see that, but people are priced out of housing right now, and it has to correct because wages can't grow exponentially to keep up with it. We're seeing rents kind of cap in a lot of areas. And I know there's a lot of people out there that are looking at the lack of inventory saying, oh, rents are going to keep going up and keep pushing because there's no inventory. That reaches a tipping point. People can only pay so much, and they'll move. So we're seeing that start to reach critical mass, and it has to correct. Prices are up everywhere. And the only way to correct pricing across the board in, goods and services that we need every day to live, and housing and things like that, you got to slow down the economy, which is a recession.
Yeah, I agree. Well, we're going to talk about earning or economic data and earnings in our second episode. But before we do, Greg, how can people find you?
Yeah, gregdickerson.com. That's where everything is. My YouTube channel, links to my YouTube channel and everything is on there. Go check it out.
Thank you, buddy.